If you invest in shares, ETFs, property, or crypto, there could be some genuine tax deductions that you might be forgetting to claim. So in today's video, we're going through 7 major tax checks. We'll cover work-related reductions, investment-related expenses, keeping your investment records and cost bases, capital gains and losses, dividends and franking credits, super contributions, and other deductions that you may be overlooking. We'll also cover some of the major tax changes that were recently introduced in the federal budget, which have now become law, including the new capital gains tax changes and negative gearing rules, which will begin from July 2027. This video is sponsored by Sum, which is a tax software that helps people who invest in shares and ETFs and also crypto in the one place, so you can more easily prepare for tax time. You can also get 20% off your first year when you use my link in the description, but I'll talk more about them later in this video. Keep in mind that anything that we talk about in this video or on this channel is general advice only and not personal financial advice. You can read my full financial services guide in the description. So sit back, relax, and grab a drink of your choice. Today I'm drinking green tea, and let's dive in. So the first thing to check is the new $1,000 instant work-related deduction and compare it with your actual work-related expenses. From the 2026 to 2027 financial year, eligible Australian workers will be able to use the new $1,000 instant work-related deduction. This allows eligible workers to reduce their taxable income from work by $1,000 without keeping records for each individual work-related expense, which sounds amazing, but there are 3 very important things to keep in mind before you use this rule. The first thing is that this rule doesn't apply for the 2025 to 2026 financial year. It applies to the 2026 to 2027 financial year, so you'll generally be able to claim it once you lodge your tax return around the 30th of June 2027. Second, unfortunately, it isn't an instant $1,000 refund. It reduces your taxable income by $1,000, so the amount you save depends on your marginal tax rate and your circumstances. If your marginal tax rate is 30%, for example, a $1,000 deduction could reduce your income tax by approximately $300 before considering the Medicare levy and any other offsets or other factors. And lastly, you can still claim your actual work-related expenses if they are higher than $1,000. Let's say, for example, you're preparing your tax return and you realize that you have around $2,500 in eligible work-related expenses. You don't automatically have to choose the $1,000 instant deduction. You can choose to claim the $2,500 worth of deductions instead. You just need to make sure that you do keep all of the proof of those purchases. Your work-related expenses could include things such as your working from home expenses, so things like your internet or electricity, your work-related car expenses if eligible work travel-related expenses, self-education expenses related to your current employment, courses, conferences and seminars, tools, computers and equipment, work-related phone and internet usage, and work-related software and subscriptions. The things that you could claim all depends on what you personally do for work. The good news is the ATO website actually has published some very specific guides on different occupations and the things that you could potentially claim based on your occupation. As you can see, there are quite a lot of things in here, so I would highly recommend checking this out to see what things that you could potentially claim. One thing to note, across all industries and occupations, you generally do need to separate the private use from the work-related use. Let's say your phone bill for the year is $1,200, 40% is work use and 60% is personal use. That means you may be able to claim $480 as a potential tax deduction. And even if you do choose to use the $1,000 instant work-related deduction, you may be able to claim additional deductions on top of that, but different eligibility rules apply. For example, you may be able to still claim professional association or union fees, charitable donations, personal deductible super contributions, investment expenses, income protection insurance, and the cost of managing your tax affairs. I personally think the best strategy is to just keep a record of all of your potential work-related expenses throughout the year, and then when it comes to tax time, choose the option that works better for you. We're on the way to reach 100,000 subscribers on YouTube, so if you're enjoying this video but you haven't subscribed yet, please make sure that you subscribe so that we can reach our goal of 100,000 subscribers on YouTube by the end of the year. Now let's move on to check 2, which is making sure that you are claiming eligible costs related to your investments. If you're investing in assets which produce income, some of the costs associated with earning that income could be tax deductible. If you're investing in shares or ETFs, some potential tax deductions could include things like brokerage fees, interest on borrowed money that you've used to invest, investment research subscriptions, and financial advice related to investments that you already own. And you may be able to claim the cost of managing your tax affairs, so things like accountant fees, or even investment tax software such as Sum. But it's always a good idea to run these things by your accountant just to double check. However, it is important to note that not every investment cost can be claimed as an immediate tax deduction. Let's say, for example, the brokerage fees that you pay whenever you're buying or selling shares. Those brokerage fees are generally included in your investment's cost base. So that means the brokerage fees are taken into account once you sell your investment when you're calculating your capital gain or loss. If you own an investment property, some potential tax deductions could include things like the interest charged on your investment loan, but keep in mind that any principal payments that you make towards the loan generally isn't tax deductible. Property management fees, council rates and land tax, rental property insurance, body corporate fees, advertising your property to tenants, and eligible repairs and maintenance. Also keep in mind that this only applies to investment properties which are genuinely available for rent. Your own home that you purchase to live in is generally not tax deductible. If you're doing renovations on your investment property, these could potentially be tax deductible, but generally these large improvements or renovations are generally claimed through depreciation over a few years or included in the property's cost base. There have also been some big changes to negatively geared properties. From the 1st of July 2027, negative gearing for residential property will generally be limited to qualifying new builds, but properties held before 7:30 p.m. Australian Eastern Standard Time on the 12th of May 2026 are generally protected under grandfathering arrangements. So that generally means if you purchased a property before the 12th of May 2026, you may still be able to negatively gear that property, but any properties purchased after the 12th of May 2026, you won't be able to negatively gear these properties unless they're new builds. But that doesn't mean that if you do make a loss on your investment property purchase, you won't be able to claim a tax deduction for some of those losses. It generally means that those investment property losses won't be deductible against your income from wages, but you may be able to still use some of these investment property losses against your capital gain when you do eventually sell your investment property. So generally, these investment property related losses are essentially carried forward instead of investors being able to reduce their taxable income every financial year like they did in the past. So that's why it's still a good idea to make sure that you are keeping records for every transaction. So under the previous negative gearing treatment, an investor might have had $80,000 worth of salary and a $10,000 investment property loss. So their taxable income would effectively be reduced to $70,000. But under the new negative gearing rules for an established property, the $10,000 loss would not be used to reduce the investor's wages, but it could be used to offset the capital gain when that investor sells that investment property or to offset future rental profits. Check 3 is to make sure that you are tracking your cost base, dividends, and investment records. Your cost base is essentially the tax record of what it costs you to acquire, hold, and dispose of an investment. And this is where today's sponsor, Sum, can actually help you with the record keeping of your investments. Sum is a tax software that allows you to see all of your shares, ETFs, and crypto in the one place. So to add an account, I simply click here, search for the broker that I use, for example, Perla. I've downloaded my trade history from Perla and I'm just going to upload it here. As you can see from my Perla account, which I uploaded as a CSV, it's found 258 transactions and total fees paid $528.20 for my Perla account. And this fees paid figure could be important, especially when it comes to tax time, because forgetting around $500 of brokerage fees paid could potentially cause you to overstate your capital gain and potentially have you pay more tax than you need to. But you also need to make sure that you are keeping track of each share and ETF parcel that you buy. A parcel is simply a group of units or shares or ETFs that are purchased in the same transaction. So let's say, for example, you buy 100 units of the same ETF for $50 each, which ends up costing $5,000. Then you buy another 100 units of that same ETF later, and it costs you $80 each. So the total price is $8,000. You now own 200 units of that same ETF. Your broker might show an average purchase price of $65, but for tax purposes, you still need to keep track of which ETF parcel you're selling when you do eventually sell those ETFs. So let's imagine the ETF price rises to $100 and you sell 100 units of that ETF for $10,000. If you sell the units that you bought for $5,000, your capital gain will be $5,000. And if you sell the units that you bought for $8,000, your capital gain will be $2,000. So the parcel that you choose to sell does affect your capital gains and whether you would qualify for the capital gains tax discount. But we'll talk more about the capital gains tax discount later, and also the new inflation adjusted capital gains tax discount that will be replacing the 50% capital gains tax discount. And that's why it's a good idea to use a tax software such as Sum, because it can help you calculate exactly which parcels of ETFs or shares that you sell and what your capital gain or capital loss could be. When you go to reports in Sum, you can download reports and basically send them off to your accountant. There's even an AI that you can chat to that can give you more information about your tax information and even suggest some things that you could do to potentially save on taxes. Some can also connect to AI tools such as ChatGPT and Claude through an MCP, and this has been really helpful, especially when it comes to dividends. Whenever I receive dividends from my shares or ETFs, I used to have to go into these tax tools and then manually put in how many dividends I received, but with Sum it's actually super easy because I can just basically chat to Claude, send some screenshots of my bank account where the dividends have come through, and it will automatically match it up in Sum and do it for me. This makes it so much easier to compare a dividend that might be missing or when some payments don't match. I personally have chosen to get my dividends paid out to me in a bank account and then reinvest them that way, but I did find that it was a little bit more messy when it came to tax time. But the good news is with Sum, even if you do dividend reinvestment plans, they do have an option for you. So you simply go into the share or ETF that you've purchased and then click this gear icon and then choose if it's a dividend reinvestment plan, and it matches it up for you. So for example, I have uploaded some screenshots of my bank account which receives the dividends, and the good news is everything has been recorded in Sum. There were a few that did have a slight difference in the dividend recorded, but I can see that everything is in Sum and nothing is missing, which is really good news. And if you would like to try Sum for yourself, you can use my link in the description to get the discount. So the fourth check is to review your capital gains and losses. If you sell an investment for more than its cost base, you make a capital gain. And if you sell it for less than its cost base, you make a capital loss. Capital losses can be used to reduce capital gains, but they normally can't be used to offset your wages or dividends. There have also been some huge changes to the capital gains tax discount. There used to be the 50% capital gains tax discount, which means if you hold on to an investment for longer than 12 months, you used to be able to get a 50% capital gains tax discount on the capital gain that you made. But from the 1st of July 2027, the 50% capital gains tax discount will be replaced with a discount based on inflation and a minimum 30% floor. So here's how this works in practice. Let's say, for example, your asset is worth $160,000 and the cost base is $100,000. Your capital gain is $60,000. Under the old 50% capital gains tax discount rules, your $60,000 capital gain would be reduced to $30,000. So that $30,000 will be added to your tax return as income, and then you pay tax at your marginal tax rate. So let's see how the new rules could potentially apply. You have the same asset that's worth $160,000, but instead of your cost base being $100,000, it's adjusted to $120,000 once you include $20,000, which is adjusted for inflation. So that means the capital gain adjusted for inflation is $40,000, and this $40,000 is added into your tax return as income, and then you pay tax at your marginal tax rate. In this example, I've assumed that inflation is 20% over the period, but in practice, you wouldn't just guess this number. The calculation would use the figures that are published by the Australian Bureau of Statistics and the official CPI rules, which stands for Consumer Price Index. The annoying thing about this new method of calculating your capital gains is it does require more record keeping, and it is slightly more difficult because you do actually need to calculate the price of inflation for the time that you've held that asset for, whereas the 50% capital gains tax discount just applied a simple 50% discount on your capital gain. But this doesn't necessarily mean that the new method for calculating your capital gain is worse in every situation, because depending on what the inflation rate was over the time that you've held your asset for, you could be worse off with these new capital gains tax changes, or it could work out better if the inflation rate was high over the period that you've held your assets for. So keep in mind that these numbers are examples only, and the actual calculations haven't been released yet by the ATO, but would likely use the Australian Bureau of Statistics and their quarterly CPI figures to calculate what the inflation rate has been over the time that you've held your investment for. If you held shares, ETFs, or other investments before the 1st of July 2027 and then sold it after this date, your capital gain will generally be split into two parts. Before the 1st of July 2027, you can generally still use the 50% capital gains tax discount, but for the gain after the 1st of July 2027, the new inflation-adjusted indexation model applies. So let's say, for example, you bought $100,000 worth of shares, and then they grew to $150,000 by the 1st of July 2027, and you later sold them for $180,000. For 50% of the gain, because it was made before July 2027, you may qualify for the old 50% discount on this portion of the gain, but for the extra $30,000 gain, this would be calculated under the new inflation-adjusted indexation model. So the fifth check is to look at your dividends and franking credits. When a company makes a profit, they generally have two choices. The first choice is they can choose to reinvest that profit back into their business to grow. And the second choice is they could choose to pay out that profit as a dividend to their shareholders. The good thing about investing in Australian shares is dividends in Australia generally aren't double taxed because we have this franking credit system in Australia. Here's how it works. Let's say, for example, the company makes a profit of $100. They pay the company tax rate of $30 on that $100 profit, and then that $70 gets paid out to you as a dividend. But instead of you having to pay tax on that $70 dividend, you get a $70 tax dividend and a $30 franking credit from the tax that the company has already paid on this dividend. So for tax purposes, even if you only essentially received $70 cash from the dividend, you may need to report $100 worth of accessible dividend income, the $70 cash payment, plus the $30 franking credit. And then you pay tax on your marginal tax rate. If your marginal tax rate is 30%, you may not need to pay any additional tax on this dividend. So you basically get to keep the $70 dividends that you were paid. But if your tax rate is higher than 30%, you may need to pay slightly more tax depending on what your tax rate is. If you invest in overseas shares, it's also important to double check whether foreign tax was withheld on your dividends as well. And the good thing is some does provide dividend information, including franking credits and foreign tax withholding. But it's important to compare that information with your official statements before lodging your tax return. The sixth step is to review your super contribution options. Salary sacrificing into your superannuation can provide additional tax benefits because they're generally taxed at only 15% when they enter your super fund, rather than at your marginal tax rate. However, an additional tax may apply to some high-income earners that are contributing quite a bit to their superannuation already with their high salary. You could also make after-tax contributions into your superannuation and claim it as a tax deduction. The cap for extra salary sacrifice contributions and after-tax contributions is $32,500 for the 2026 to 2027 financial year. But some people might be able to use more by using uncapped amounts from previous years. The only downside to this, in my opinion, is you can generally only access your super once you reach retirement age, which is around 60 or 65. So depending on your age, you might be waiting quite a bit of time before you're able to access these contributions. So that's one thing to consider. But there is actually a way that you can access your extra salary sacrifice contributions earlier, and that's called the First Home Super Saver Scheme. So if you haven't bought your first home yet, this could definitely be something worth looking into, because super is generally only taxed at 15% when it's entering your superannuation, whereas a lot of our marginal tax rates might be 30% or above. But one thing to note is that when you are withdrawing your extra salary sacrifice contributions for the First Home Super Saver Scheme, there may be some extra top-up taxes that you need to pay based on your marginal tax rate. So it's a good idea to run the numbers to see if it makes sense for you. So the seventh check is to look at any other deductions or tax considerations. For example, donations above $2 which are made to registered charities may be tax deductible, and insurance premiums for income protection insurance could also be tax deductible as well. However, life insurance premiums, trauma insurance premiums, or policies held inside super could be treated differently. Private health insurance itself isn't generally a tax deduction, but it can affect if you pay the Medicare levy surcharge, which is an extra tax on high-income earners who don't have private health insurance with hospital cover. All taxpayers generally pay the Medicare levy, but the Medicare levy surcharge is an extra tax on high-income earners who don't have private health insurance with hospital cover. So if you earn more than $105,000 as a single or $210,000 as a family, you may be paying the Medicare levy surcharge. It doesn't mean that everybody earning above this amount needs to take out private health insurance with hospital cover just to avoid paying the Medicare levy surcharge, but it could be worth it, especially if you are already considering private health insurance with hospital cover. So the 7 tax checks Australian investors should review are: number 1, reviewing work-related deductions. 2 is claiming eligible investment costs, such as interest on an investment loan, tax management costs, property management fees, repairs, brokerage fees, and more. 3 is to make sure that you're keeping accurate records of when you buy and sell assets. 4 is reviewing your capital gains and losses, including any losses in previous years that you could carry forward. 5 is checking your dividends and franking credits and making sure they've been recorded properly. 6 is reviewing your superannuation contribution options. And 7 is checking any other potential tax deductions, like donations and some eligible insurances. Thanks again to Some for sponsoring this video. I've got a link in the description below if you would like to try them out for yourself. And remember, you can get 20% off your first year when you use my link in the description. And write me a comment below with the word receipt in there, just so we know you watched this video all the way through. Thank you. Bye.